All right, let's talk about all of this and more with Mayuresh Joshi, Head of Equity Research at William O'Neill, India. He's joining us right now on the show. Mayuresh, very good morning to you. I mean, we've spoken in the past, and the setup now clearly focusing more on corporate earnings and what we do thereabouts. But individual stocks also now, in their own way, have started to see a lot of interest coming in, especially new listings. And since I'm more keen to know your thoughts on IRCTC, at about 700 plus, 733 was its close yesterday. Valuation of 40 times plus now from the issue valuation of 18.5 times. Does it make sense for anyone who, or is it a complete miss the bus situation?
So morning Devina, morning Neeraj. So first of all, wish you a very happy birthday. Just
Thank you.
Neeraj, wish you that. Specifically coming to the issue of IRCTC, right? Valuations are off the table at this point of time. So I think the subscribers, the kind of response that it probably got, the response that got evinced in terms of the listing itself, very clear in terms of the price action. There are a lot of factors which actually stand in favor of IRCTC. So it's a sole distributor. So I think the moat that it probably has around its business model is going to remain very, very strong for the near foreseeable future. The second element obviously is the convenience fee, and though there is some amount of dispute on that part, I think if the convenience fee probably stays with them, I think it directly flows down through the EBITDA and the bottom line. The third element obviously is the net debt-free status. With the improvement expected in terms of new routes coming through on the railway system itself, and the expectations of internet penetration actually taking volumes far higher, you've actually got a very strong business mode surrounding it, very strong business fundamentals as far as the P&L and balance sheet are concerned, and the dividend payouts are large as well, which brings us to the fourth point of valuations, right? And valuations are extremely, extremely pricey. But again, I think there is no direct comparable at this point of time. I think I had read a few reports before the issue was out on comparisons made with Make My Trip and so on and so forth. But I think it has some length to go to that distance, because if you probably look at our infrastructure from a railway standpoint, convenience of travel, the comfort of travel, it's not there when you probably look at international standards. So I think it's a long way to go out there. But again, I think the investors have probably got the offering. I think they're better off staying put, at least at this point of time. There was a joke moving around apparently. I think if you don't have the shares of IRCTC, apply in the Tatkal system.
Yeah, that's interesting. That's a very nice one actually, early morning on Tuesday. Just one small bit that I want to add. And again, not an apple-to-apple comparison, but it takes me back to NBCC's listing and post the listing. Yeah. No direct competitor, and a lot of talks about what happens to NBCC if the government opens the door to private competition, which is something that is being argued for IRCTC. We've seen thus far, there has not been any direct competition open, though NBCC's got a saga of its own that's separate.
Absolutely.
But no direct competition. So this whole talk about what will happen to valuations if competition comes in, I think that argument should be thrown out of the window, to be honest. Just leave that out and then try and look at the other parameters.
Yeah. But and in terms of internal transportation for India, I think railway is probably the backbone of the Indian transportation system, at least from a travel standpoint, while you have your cars and your buses and road transportation, but railways...
And to add the point, I think that will keep on increasing, because if you're probably looking at the urban class, they might probably go for air transport. But for the large rural diaspora at that place, I think it is one of the...
To be honest, I hear a lot of urban guys also now starting to move to rail because I think the services are showing some signs of improvement. Anyway, just the other one, Mayuresh, and something that is much larger, HUL. The volume growth numbers at the upper end of the expected band, margin improving, and the commentary didn't sound all that poor. What did you make of that, and what do you then do with the stock?
So I think, as we discussed last week as well, I think the rural growth clearly has come off. So I think that was what we were anticipating, the rural growth will come off, because the outpacing of rural growth is clearly a growth driver for all consumption-driven stocks. So that's one. The second element in terms of adjusting for Ind AS 116, I think then there is a 200 bips improvement in margins on a comparative basis. But still, that's far better than what one really expects. You're absolutely right. I think in terms of volume growth, better in terms of the context that we are hearing about in terms of slowdown and slowdown pressures, and HUL clearly has stood the test of time. But again, I think two, three things. One, I think rural slowdown still evident as the management is still putting forth. The second element obviously is going to be pricing, because for all these FMCG driven companies, I think it is volume led pricing growth which creates huge leverage on their balance sheets. So one of the legs is clearly missing at this point of time. Volumes are a little bit tepid, pricing still not there. So I think the clear operating leverage that one looks at, probably as I said, might get deferred till the RBI output probably comes out out, which is fourth quarter. But nevertheless, I think the performance was quite good. We have taken a few price cuts in few categories. But again, I think introduction of a few products that have come through, strong revenue growth still continuing for the company, again brings us to the argument of valuations. But again, I think valuations have always been at a premium for HUL. So at least at William O'Neill, I think we try to mix fundamentals and technicals as we discussed last week. So fundamentally, I think the strong is looking very, very good from an earnings perspective, from a valuation perspective, probably a little bit higher. But from a price perspective, I think it has shown tremendous improvement. A little bit higher than our comforts, at least as pivot levels are concerned. I think we'll watch out for levels around 1875, 1880. I think if it pulls back to that level and consolidates, I think it becomes a very, very good stock, and it does lie in our conviction buy list.
I want to ask you about IndusInd Bank. When it reported its numbers, I think that day when it reported numbers was a day when the bank nifty was down about 800 odd points, so probably a trickle effect on IndusInd Bank as well. Did you think the numbers were okay? I mean, there were some additional slippages, but the management managed to clarify a lot of things and put light on a lot of things with regards to how they've used the savings from the corporate tax, what they've done with those stressed accounts.
So I think two elements stand here. I think one, in terms of the savings that would come through on the DTA front, were clearly going to get plowed back in terms of higher provisioning. So that was one thing that was given in terms of expected numbers, and that is probably how it has played out, at least as this one is concerned. The second element in terms of asset quality slippages per se, I think there is still some element of doubt that few of the analysts on the street probably believe might still play out in terms of balance sheet dynamics. So I think you might need to give it a quarter more to probably assume that a lot of the distress in the balance sheet has probably got recognized. By the way, the corporates are failing every alternate week, and you hear some news coming out. I think the comfort level probably still doesn't stay out unless there is a surety that probably comes through that a large part or large element has probably got recognized. In that context, I think ICICI Bank, which I've been liking for a period of time, has stood the test of time. It has done a large part of its recognition. It probably might report a reasonable set of numbers as far as Q2 is concerned and stand out within the corporate-led pack. I think everybody's probably moving towards retail at this point of time. So again, ICICI probably still stands out if you're probably talking about the larger private sector things.
All right. Mayuresh, in fact, coming to you with the IT stocks and what Infi and TCS have done, what is expected out of WIPRO. Obviously, the outperformance of Infosys is reflected in the kind of outperformance in the stock price versus the TCS. But what would the play be now on IT?
So I think we still believe that if you probably stack up the top tier names and the results which have come out so far, I think TCS did disappoint in terms of all parameters. So if you're probably talking about revenue growth, when you're probably talking about EBIT margins at 24%, I think one of the lowest reported in Q2 by TCS. I think the only points which stand out for the top tier names is the order book at hand at this point, and the order book remains extremely solid for execution to probably still continue. But again, you're typically entering Q3, Q4, which are the weakest quarters for the sector as a whole. Furloughs, Christmas holidays will largely dominate Q3. Discretionary spending patterns will dominate Q4. So I think most of the elements which were missing in Q1, wage hikes, visa cost, have effectively played out in terms of Q2 numbers. But again, I think if you probably stack it up, and in our opinion, again, I think Infosys probably looks a tad bit better placed compared to the other top tier names. Obviously, the guidance that they've upped, I think that's a positive. But the second element in terms and in lieu of global slowdown, what actually happens with the BFSI sector, because that contributes 30 to 32% of the overall top line, is going to be extremely critical. So if you need to stack it up, I think it's probably Infosys that still stays on top for us.
A couple of mid-size or small-size financiers, Mayuresh, everybody talks about Spandana Sphoorty, and we've discussed that at length. Two others, one of them was Mass Financial that we spoke to yesterday, sounded fairly confident. The other one is Aavas Financiers, which after the 3.5% up move yesterday is trading at fresh 52-week highs. Do you cover either of these two?
Yeah, so we do cover, and Aavas is something that we did like a few months back. The moment has been pretty stark, but I think there are strong numbers which are probably justifying that move as well. But does that justify valuations is a different element at all. So I think if you probably look at the core numbers itself, the AUM growth has been pretty decent. It stands around 6,600 odd crores at this point of time. The disbursements growth over the last few quarters has remained rock solid. Predominantly, the entire exposure is towards retail. Home mortgages is almost 75 odd %. Within that, again, I think the self-employed is a large structure again. And that gets clearly reflected in terms of asset quality as well. So GNPA is at 0.58 for the quarter gone by, net NPA is at 0.4. They have been still been resilient enough to maintain their spreads and margins as well at around 8.1, which gets reflected in a better ROA at 3.17. So you can't complain in terms of the core parameters when you compare the other HFCs at this point of time, the other NBFCs. But again, I think it comes back to those arguments of valuations versus growth. So growth clearly there, whether it will lag off in the coming few quarters, doesn't seem so from the quarter one performance. So I think absolute stellar performance as far as earnings and price both are concerned. But I think it's moved up a little bit too sharply in our opinion over the past few weeks.
What about autos, the four-wheelers, and if you have to look at it from even a standpoint of the festive season cheer, I mean, it was better than last time, but it wouldn't match up all the way.
Oh yes, and again, I think I've always maintained that stand. I still continue that stand that autos are still on a weak footing. I think the volume numbers even for September were not encouraging at all. If you look at the MHCV players, for example, I think production cuts have still got announced even in this month by Ashok Leyland, for example. The PV segment, the two-wheeler segment clearly has its impetus laid out in terms of how rural growth happens. Rural is clearly lagging at this point of time. So I think to push through volumes, at least for the festive season, discounting will come at the fore, which means they're going to take a margin hit. Volumes are not great, which means that the volume-led price growth also for auto companies are non-existent at this point of time. They can't take huge price hikes as well. So they've already done that in Q1. For example, the CBS or the ABS hikes have gone through in Q1, and that did not substantiate because volumes was clearly not there. So I think that clearly had a demarcation done in terms of the reported EBITDA numbers as well. So I think it's going to be a while till the recovery happens from an earnings standpoint. Do I preemptively play that out? I don't think so. I think let there be a couple of months sign that the numbers are actually improving, whether that happens now, in November, December, I don't want to take that call. But if those 2 months, 3 months are an encouraging sign, and even if I miss that initial rally of 10-15%, I don't mind that because I think I've got a solid base to work with, where numbers are probably looking on the uptrend or the upswing, and there is certain amount of surety that there will be stable numbers reported in the quarters to come. So I'll wait it out even if there is a 10-15% upswing in the next few months. But the numbers have to get stable and the numbers have to be in line in what the street probably estimates. So I think I'll take my time for autos.
All right. What about pockets where you feel that it's better to just start investing now itself? What would those pockets be? If you're saying you don't want to preempt auto, if you have to make an investment, you must have had your eye on a few stocks that you like and you want to put money into. What would those stocks be?
So I think a few of these gas distribution companies look attractive. The movement has been pretty sharp, but again, I think the dynamic surrounding the entire environment probably looks very, very attractive at this point of time. The need for cleaner fuel, what has probably happened in terms of pricing. So even if gas prices move higher, they do pass it through, which means that there is a very minor pass through happening both in terms of domestic gas as well as commercial gas, and that doesn't pinch the end customers as well. But it protects the EBITDA per SCM that these companies probably report. With more and more cities probably coming for bidding, more CNG stations probably getting put out, I think the recovery of cash happens far faster than what probably one realizes. So I think IGL is something that we probably like within the CGD space.
Not Adani Gas.
I mean, we've not looked at numbers.
Okay, fair.
So I think IGL is something that we probably like at this point of time. MGL obviously has the overhang in terms of the stake sale still creating some amount of apprehension. And the other pocket that we probably like is being very, very selective within the mid-cap universe. So I think I'm going to discuss a 5-digit stock, which is very, very unlikely. But Honeywell Automation is something where our belief is that this stock can really do very, very well going forward. Two key triggers for that stock. I think the fuel transition from BS4 to BS6. I think 80% of the technology is something which these guys probably possess at this point of time. And even from a refining standpoint, I think the conversion from naphtha to other gases and vice versa, I think they've got the technology in place where refiners can actually make a killing in terms of optimizing their cost. New capacity is coming up at 15%. I think the new capex, these guys stand to make a killing as well. Strong earnings growth, margins have improved at 12%. Unfortunately, it's a 5-digit stock.
5-digit stocks in the past have created some serious wealth. iShare from 10,000 to 30,000, or MRF from wherever it was to 80,000. Quite spectacular. Some flashes are on your screen, by the way. Yes Bank, some numbers coming out about how they've recovered some amount by the stake of the Fortis stake. And Fortis, remember, corrected about 4.5% in trade yesterday. The interesting bit would be that now it's wedged in these levels of 120 to 140. Doesn't go down too much. The point is, because of all the overhangs that exist, Mayuresh, is it a stock that you would risk your money with, or are there better plays available? I don't know if you track it or no, but just a rough guesstimate.
Yeah, so used to track it. Controversy started, we dropped tracking it.
Okay.
And again, I think if you probably compare what it is doing within the healthcare space, I think the leader probably is doing far better at this point of time. So again, I think very less choices if you have a like-to-like comparison. But as you rightly pointed out, I think there are far better stocks in the market at this point of time.
A few other stocks that came out with results yesterday. You had a GTPL Hathway and you had a Delta Corp. Mayuresh, what did you make out of any of these, if you managed to have a look?
So frankly, I think as Neeraj pointed out, I think Delta's clearly gone through its phase of high growth, and it's probably lagging now at this point of time. Similarly for GTPL Hathway, I think numbers were reasonable in my opinion, but again, I think look at other stocks at this point of time.
Okay. The other pocket is the metal space. There is one theory that suggests that even if you want to look at value investing, you start looking at pockets which are cyclically weak. There's no structural weakness, but there's cyclical weakness, and at some point these companies will come out of that weakness. Do you see that happening to metals?
So let them come out. It's as simple as that. No, the entire element surrounding these commodity-driven stocks is obviously pricing and volume growth, both, right? If you probably look at expectations this quarter, whether ferrous or non-ferrous, I think prices are down. Aluminum prices are down 2 to 4% on a year-on-year basis. Zinc prices are down almost 12% on a year-to-year basis. You look at steel prices, HRC, CRC prices have cooled off significantly. Volumes are also going to come off. So when you probably are expecting volume-led price growth, I think that is clearly going to get missed out as far as metal companies are concerned, whether it's ferrous, non-ferrous, coal companies, iron ore companies. Alumina prices, for example, are down 18% on a year-on-year basis. So there is no respite for metal companies as a whole. My entire take is that the Q3 might be relatively better, because what you've probably seen in terms of iron ore prices, coking coal prices at around $60 a ton, I think that might provide some respite. But whether I take a call right now, assuming the pricing environment, the demand-supply dynamics, I think it's too tough for commodity-driven companies. So again, like auto companies, I'll probably wait out. I think if the tide has to turn, I'll wait out for that tide. Even if they move 10-15%, it gives me the confidence that the worst probably might be over. And then I think taking constructive bets on the sector probably looks good. At this point, not interested in the metal story.
Well, we'll watch out for some of these names. Mayuresh, these divestment names, and I think we spoke briefly, but fundamentally, a BPCL or a Shipping Corporation of India, you never know when the story might play out, but would you still go out and bet on any of them?
No, so I think let it play out. And again, I think as we were discussing right now, I think for BPCL in general, I think what kind of valuations get ascribed are going to be extremely critical, because if you take a precedence of how the SR Oil deal had happened with Rosneft, I think SR Oil at 20 MT, 1,000 megawatt captive power with 3,500 retailing stations, BPCL has got around 35 MT, 15,000 retailing stations. So I think the moat clearly is there, because 1/4 of the retailing outlets stay with BPCL. The pipeline valuations are also getting ascribed as far as the downstream products are concerned. They are variable in terms of how crude prices move. So I think there is a lot of EV/EBITDA ascriptions that can probably happen across their businesses. But what value probably gets ascribed, if you probably compare the SR valuations, which was quite a while away at this point of time, I think if they're able to privatize that, I think the government will get a lofty, share. But then again, I think there should be an open offer coming through. So I think the buyer is actually looking at anywhere northwards of 80,000-90,000 odd crores. In market conditions like these, I don't know whether the buyer will come through with that entire amount at its disposal. So that, I think, in terms of valuations, need to watch out. For Shipping Corporation in general, I think with spot rates having zoomed off and a couple of ships being deployed as per our channel checks, I think maybe these quarters numbers or the next might actually reflect, because they might actually make a killing in terms of the spot cargo tankers, which were hovering $20,000-$30,000 per day, have actually zoomed up to around a lakh 25,000 a day. So I think some of these operators can actually make a killing based on the short-term movements that the tanker rates have to offer.
It's just a forward that was circulated yesterday with regards to how the NBFC market cap has moved in the last 1.5 years. To say that 8,60,000 crores was the total market cap of about 28 NBFCs, which has stayed 8,60,000 crores, but the variables in between have just totally skewed themselves towards an HDFC Bank, Cholamandalam, Bajaj Finance, Muthoot Finance, 4 or 5 names out of 28 names that have managed to keep market cap levels at the same point. Do you feel that this is the pocket that's going to continue to charge further ahead?
So NBFCs have clearly got hit because the liquidity concerns which were plaguing the entire industry few quarters played out detrimentally to the sector as a whole. Secondly, I think the borrowing was still not coming through, so the borrowing cost has obviously improved. The better rated NBFCs obviously got a reasonable amount of borrowing still coming through. The AAA bonds had no issues at all because they were borrowing from the bond market itself. The low-rated paper or the low-rated NBFCs had huge issues in terms of borrowing, which had a huge spike in borrowing cost and contraction in spreads, along with the loan growth probably not moving at the pace one desired. So I think this double whammy probably played out on numbers. The better rated, the better quality NBFCs have stood the test of time, reflected by reasonable advances growth, asset quality pressures remaining stable. And though a marginal hit has been taken on their NIMs and spreads, the sustainability still remains with the better quality names. So our philosophy still remains the same, I think, stay with better quality names through volatile times specifically that we are probably witnessing at this point. No point in chasing stocks where valuations have come off, just with the argument that they're probably looking cheap at this point of time. Cheap can even become cheaper.
Cheaper, for sure. On that note, Mayuresh, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time.
Thank you.